The Morgan Report with David Morgan. Discover how to build and protect your wealth at themorganreport.com.
David Morgan of themorganreport.com for the week ending 12 July 2024. Well, this week I'm going to look at the macro picture. This is an article I wrote and submitted for Prospector News, Michael Fox's publication, and it is titled, Bail-ins Will Not Bail You Out. Your bank deposits are at significant risk. Despite major banks claiming stability after passing stress tests, an ominous financial crisis looms. Ironically, banks today are far more leveraged with derivative exposure than they were in the 2008 Great Recession, which was primarily caused by the home mortgage sector. Now, with derivatives rampant across the entire financial sector, depositors need to understand that they are not first, nor second, in a line to retrieve their funds in case of a bank failure. Since the 2008 crisis, banks have been deemed too big to fail, and these banks have grown more powerful and larger. Investment legend Warren Buffett has long warned that derivatives are financial time bombs for both economies and individuals. In 2011, former Fed Chairman Paul Volcker resigned from the Obama Economic Recovery Advisory Board out of frustrations over continued unregulated derivatives. The global economy's current recession is being denied and exasperated by attempts to print money as a solution. Recall the aftermath of the 2008 crash, when U.S. government's troubled asset relief program, TARP, spent over $426 billion buying the worthless mortgage-backed securities and declining bank stocks. This program led to the creation of the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010, which promised an end to bailouts. However, the bill's 30,000 pages, heavily influenced by bank lobbying, did little to protect the average depositor. Instead, the Dodd-Frank bill introduced bail-ins, where depositors' funds were used to cover bank losses before depositors can access their money. This was a significant shift from the previous practices where depositors, as secured creditors, had previously been in a liquidation event. Now, with the new rules, depositors are considered unsecured creditors, and derivatives and other high-risk investments are paid off first. Title II of the Dodd-Frank empowered the FDIC with the Orderly Liquidation Authority, OLA, similar to what the United Kingdom has, the Prudential Regulation Authority. The Canadian government has adopted similar measures with its Economic Action Plan of 2013. These reforms allow banks to use depositors' funds to cover losses and a process known as bail-ins. Today, the global derivative exposure by banks exceeds $1 quadrillion, far surpassing the housing involvement in 2008. The creators of Dodd-Frank and the PRA knowingly shifted this burden to depositors. John Butler highlights the deceptive nature of these reforms, which subordinate depositors to other claims. Post-2008, millions lost their homes, pensions, retirement plans, while bailouts preserved the too-big-to-fail banks. In 2010, the too-big-to-fail banks were also refined as globally active, systemically important financial institutions. Dodd-Frank's bail-in provisions allow banks to convert depositors' funds into bank stock instead of cash. This approach was used in Cyprus, Greece, and Spain, whereas depositors receive stock worth a fraction of their original deposits, usually so far in those three between 5 cents on the dollar and 8 cents on the dollar. China now faces similar issues with its banking system on the brink of crisis. The Chinese government has also begun repaying depositors with bank stock, leading to public outrage and military intervention. It seems many citizens worldwide have become complacent and trust the system. This is a huge error, and the time is short in my view. If you have not considered what would happen to your financial well-being if a bail-in were to occur, you must not only consider the possibility, but take appropriate action. As the currency crisis unfolds, remember two crucial truths as written by Brett Redmayne-Titley. Never trust a banker, and when your bank fails, don't walk, run. It's David Morgan from themorganreport.com. That's my weekly perspective for this week. I will be back with you next week with another weekly perspective. Hello, it's David Morgan again. The financial landscape has drastically shifted since the pandemic. The old rules, they no longer apply. Inflation is spiraling and traditional investment paths aren't making you wealthy. You're watching your wealth diminish. But here's the good news. You don't have to be a passive spectator to your own financial decline. We're thrilled to announce an exclusive limited time offer at the Morgan Report. For those who join us now as premium or mastermind members, you'll receive a complimentary 30-minute consultation with me. With decades of experience, I can help you navigate even the toughest economic climates. This is your chance to get personalized advice tailored just for you. But act fast, this offer won't last long. Whether you're looking to refine your current financial strategy or start fresh, this consultation could be the turning point. Imagine having direct access to insights that could safeguard and grow your investments during these volatile times. Signing up is easy. Just head over to themorganreport.com. As a member, not only will you get this exclusive consultation, but you'll also gain immediate access to the Morgan Report Opportunities, a resource where we share our top investment recommendations and strategies. Don't just take our word for it. New members can try us out for 30 days. If you find the consultation and advisory newsletter isn't for you, we'll refund your money. Remember, this offer is only available for a limited time. Don't miss your chance to get ahead in this uncertain economic climate. Join as a premium or mastermind member today and start your journey toward a more secure financial future. Thanks for watching. If you have any questions about the offer or your investment strategy, leave us a message. Until next time, stay smart, stay safe, and keep building your wealth.